and we are going to jump back into our chapter 2 lecture. So again, we're just in this introductory phase where we're learning terminology. We're learning about, sort of how we got to where we are now, this audit environment that we're in now. How did the profession get here? So just learning a little bit of history about the audit profession. And we started that conversation with a discussion of different types of auditors, different types of audit services. But again, you'll remember on this slide, so this is slide 4 of chapter 2, that highlighted there, the financial statement audit and the internal control audit, because that is what we are focused on. There are a variety of different types of audit and assurance services that firms can provide to their clients. What we are focused on is the financial statement audit and the internal control audit for our client named Earthware. Very good. Okay, then we kind of, again, describe sort of the structure of public accounting firms. What does an audit team look like, right? What are the members of the audit team responsible for doing? Again, sort of a progression, a timeline of how did we get here? How did we get to the point where we are required, public companies are required to have both a financial statement audit and an internal control audit? We sort of described the timeline of, why that came to be. These specific pieces of government legislation that, again, dictates what public firms must do on an annual basis with regard to their financial statements and their financial reporting. And then we left off with this idea of context. So when we're thinking about conducting an audit, right, obviously different clients are going to require us to do different things in order to gather evidence that we need to form our conclusions, right? But at its very foundation, each audit is going to be based in the same sort of context. We already described some of that in chapter 1, right? We said no matter what kind of audit you're on, you are going to have to understand audit risk, materiality, and evidence, right? Those are those sort of 3 underlying concepts that are going to be applicable no matter what kind of audit you're doing, what kind of client you're engaged with. Other things that are going to be consistent across clients, right? Again, big versus small, different industries that they're in, different geographic locations, different types of investments that they hold, right? Legal structures. No matter what kind of audit client you're talking about, you want to sort of have this basic understanding that's going to allow you to move forward with planning for your audit. So you want to understand what is the governance structure of your audit client. So each one, I introduced this to you, and then I said our next class period, we would go through each one in detail. So that's where we're picking up. Okay, so the ones that have a little asterisk next to them, that means that there's additional slides that describe that. So corporate governance, what does that mean? Right? It's basically the hierarchy of oversight within an organization, because that hierarchy of oversight is going to help that organization understand where they need to invest their resources in order to reach their objectives, right? Every organization should have a set of goals, short-term, long-term. This governance structure, this hierarchy of sort of supervision is going to help allocate resources in order to reach those objectives, okay? Now, when it comes to our audit, yes, we need to know, right? We want to see, sort of the flow chart, the pyramid of who reports up to who in each department. That's important for us when we're doing our internal control audit more specifically. But what we're talking about here is at the very, very highest level of governance, of supervision. At the very highest level, publicly traded companies have what's called a board of directors. Is this a familiar term to you? Okay. Hiram College has a board of trustees, serves the same purpose, but for a private educational institution, they call it a board of trustees, versus most public companies will call it a board of directors. They are in charge of making high level decisions within an organization. One of the most important decisions that the board of directors makes is who should be at the executive level of this organization making decisions. Who should be the CEO? Who should be the CFO? Who should be the chief information officer? who should be the chief systems officer, right? There's a variety of different sort of high level, we call those C-suite officers, right? Because they're all at that chief level where they're at the highest level of decision making within the organization. The board of directors is the ones that hire those people. They're the ones that decide who should be the CEO, the CFO. Okay. Within that board of directors, though, is a subcommittee, right? So imagine that the board of directors has 30 members on it. Okay. Each member of that board of directors will allocate their time to different subcommittees so that they're focused on different things going on within the organization. One of those subcommittees is the audit committee. Okay. And the members of the board of directors that serve on the audit committee, okay, are required to oversee the engagement between the auditor and that business, that company, okay? So when we as the auditors find significant findings within our financial statement and internal control audit, we have to report those findings to the audit committee directly. We have direct communication with the audit committee, right? And this, again, speaks to our independence within this organization, right? We're not behind closed doors with the CEO trying to figure out how to cover something up that we found. No, we go directly to the audit committee and say, these are our findings. These are our material findings that you need to be aware of. Okay, so direct communication with that audit committee. The members of that audit committee, okay, also must be independent of that organization. Now, that's a little difficult, right? Because they're on the board, right? And board members typically get paid for their services. In a private educational institution like Hiram, the board of trustees don't get paid for their services. So when they attend meetings, when they go to different functions, they don't get paid for doing that. In the corporate setting, the board of directors typically get a fee. So for every meeting they attend, they get such and such fee. For every event that they have to be a part of, they get such and such fee. So to say that the audit committee is independent, there's a little haziness there, right? But the idea is they should have no direct financial interest within that organization to be serving on the audit committee. And more often than not, we want those audit committee members, or the business wants those audit committee members to have some sort of finance and accounting background, right? So you'll see people on the board of directors that have already been a CFO at another business, or maybe they were chief accounting officer at another business. They serve on the audit committee because they have the expertise to understand what is an audit supposed to look like, right? We want the audit committee members to understand what an audit is supposed to look like, okay? So when we talk about corporate governance, again, we do want to understand more of the nitty-gritty details of sort of within each department, right? Who reports up to who and who is responsible for what? Yes, we want to understand that, but that's going to be more part of our internal control audit. This is talking more about at the very highest level, what does the governance structure look like with the board of directors and the audit committee? Okay, does that make sense? Have you heard of audit committee before in another class? I can't remember. Okay. So a model of business. So each audit client that we go into, we want to get an understanding of these basic things because they are going to provide context for how we should conduct our audit. We want to know, what does the governance structure look like? How does the audit committee get put together, right? What do the members of the audit committee, what kind of expertise do they have? What line of communication do we have with that audit committee? Okay, those are things that we have to understand about our audit client. We also want to understand about our audit client, what are their business objectives, both short-term and long-term goals, and then what strategies are they putting in place to achieve those objectives, right? We want to have an understanding of that. What are their goals? What are they doing to achieve those goals? What kinds of activities are going on within the business that they are implementing to achieve those goals? We want to get an understanding of that. We want to get an understanding of their basic business processes. I mentioned to you before that more often than not, the audit clients that you are engaged with will have these 5 main business processes. They will have some form of financing function. So the financing function is not the accounting debits and credits, keeping track of the accounting records. The financing function is we need to go out and renegotiate our loan. So that we need to have a financing function that is able to do that, right? Correspond with the financial institutions, understand the legal ramifications of that renegotiation. We need to have a function that's able to do that. That finance function would also serve to support the issuance of more common stock, or maybe even an initial public offering, an IPO, right? We want to issue our stock into the public exchange. We need a finance function that's going to help us do that, okay? That's what the finance function is for. Purchasing, right? We said even if a company is, like I worked for insurance clients, they're not purchasing inventory to put like in a storefront for customers to come and buy, but they still have to purchase office supplies. They still have to purchase desks. They might have to purchase a new office building, right? So there still has to be a purchasing function, a process that allows them to do that. So all organizations are going to have a purchasing process. Human resources, right? Every organization is going to have some form of human resource function that's processing payroll, hiring and firing, calculating benefits, calculating bonuses. Human resources is going to be involved in every organization, every audit client that you have. I'm going to skip number 4 for a second. The revenue process. That's going to be the focus of our audit procedures for our audit client. Because I mentioned to you, we just don't have time to do all of them in 12 weeks. So we're going to focus on what are the audit procedures that we need to conduct around the revenue process. And again, every organization is going to have a revenue process, whether it be Hiram College and tuition revenue, right? How do we generate tuition revenue? How do we account for tuition revenue? Or Target, where there's merchandise on the shelves and customers come in and purchase it, right? So both services and products are going to have a revenue process, all organizations. The reason I skipped number 4 is because some organizations may have the inventory management function, right? Organizations that sell products to their customers, or organizations that produce the product themselves, they manufacture the product. They have to have an inventory management function. They have to have someone making sure, or a department making sure, right, that they have enough raw materials to produce the goods that they expect to make, that they have enough goods on their shelves if they're a retail store, right? So some organizations are going to have an inventory management function. Insurance clients don't have inventory management. There isn't any inventory to manage because insurance clients are providing insurance coverage. That's a service, right? That's not necessarily a tangible product that they're selling. It's a service, insurance coverage to their customers. Okay, so you could put a little asterisk next to inventory management because again, a lot of clients that you will be on, manufacturers, retail stores, they will have an inventory management process. But other clients that provide services to their customers, they're not going to have inventory management. Make sense? Okay, but the other 4 are going to be present in all of the audit clients that you conduct services with. Well, I just kind of gave you the answer to this. How might the components of our model differ for an entity in automobile manufacturing versus banking? I gave you the answer, right? Because automobile manufacturing, they're going to have that inventory management function, whereas the banking, a financial institution, again, they're providing services to their customers. Now, a banking institution might have a lot more around sort of cash management, right? Their cash management process might be a lot more significant. Their processes around investments at a financial institution going to be a lot more significant than, say, an auto manufacturer. So you can see how, for the most part, right, the general model of business, having a finance function, an HR function, purchasing and revenue, is going to be the same for the majority of your audit clients. But then there are going to be some little nuances depending on what kind of industry that they're in that are going to change your approach to the audit, right? All of this is for us to get context to understand how do we approach our audit, right? We need to understand these things about our clients so that we know how to approach our audit. Okay, I'm going back up. So we talked about governance, business objectives and strategies, business processes. Once we understand our clients' business processes, we can identify risks. Where within this revenue process, right? Generating revenue, selling products to customers, because that's who we're going to deal with, Earthware. They're a retail client. How do they generate revenue? By selling products to their customers. We have to understand what that process looks like. Once we understand what that process looks like, we have to imagine where could something go wrong in that process to where the financial statements would not be accurate. I will give you a for example, okay? Let's say that Earthware sells products to new customers without doing any sort of credit check on that new customer. So any customer that sends an order into Earthware, they sell their products, right? And we don't ever, Earthware doesn't ever check the credit of their customers. What could go wrong in that scenario? Dylan, the customer doesn't pay. And if the customer doesn't pay and Earthware is sitting with an account receivable on their records, that's not accurate financial reporting, because that is not a valid receivable because they have customers that aren't going to pay, right? So risk. A risk is where something could go wrong in the process that's going to create inaccurate financial information, okay? In addition to the risk, we want to identify a control. So yeah, there's a risk that they could sell products to a customer and that customer isn't going to pay. So what control can Earthware put in place, right? Do a credit check. Any new customer that sends in an order has to have a credit check done. That will prevent us from selling goods to a customer and never getting the money for it, okay? So understanding risks within the process, where could something go wrong that could ultimately affect the accuracy, the reliability of the financial statements? Where could something go wrong? Risks. And then what are they doing in order to make sure that that thing doesn't actually go wrong? And that the financial statements are going to accurately reflect the performance of the business over that given period of time. Does that make sense? Risks and controls. Excuse me. And then finally, reporting. So you see here that that reporting piece in our diagram goes sort of two different ways. That reporting piece goes both internal with performance measures, right? To make sure that when we are assessing different departments, we are able to use our financial statement information to understand what were the performance targets of that particular department over that period of time, and then did they meet those performance measures, right? So internal, and then external, right? That's where we're producing financial statements on a quarterly and annual basis for public consumption, right? They get issued to the public. So every organization, every audit client that you are on has to have some form of both internal and external reporting. What does that process look like for internal performance measure reporting and external financial statement reporting? Okay. So these are the things that we need to understand about our audit client. And we're going to dive into way more detail about these things when we actually start doing the audit work for Earthware, beginning in chapter 3. Understanding our audit client, because the only way that we can set up an audit plan, which is going to be the steps that we take to gather evidence so that we can form our opinion, right? Remember, that's our goal. Our goal in this class as the auditor is to form an opinion on those financial statements and on that internal control system. The only way that we can do that is by setting up a plan. And that plan will help us gather the evidence that we need. The only way that we can set up the plan is if we understand the client, because not every client is going to look identical, but they're all going to have sort of these things going on that we have to get an understanding of that will provide context to our audit. Okay. Any questions about this diagram? Okay, so I'm skipping a couple slides because we already went through these. Now, thinking about how our audit profession is governed. Okay, so this diagram is in the chapter 2 text materials. Try to blow it up a little bit. I mentioned to you, I can't, sometimes the stuff we talk about in financial accounting in auditing actually carries over. So I think this was something we talked about in financial accounting. The Securities and Exchange Commission was originally given the responsibility to produce both auditing standards and accounting principles. So Congress said, the Securities and Exchange Commission, you need to make up all the accounting rules, GAAP, and you need to come up with auditing standards, the standards that auditors have to follow when they're conducting their audit procedures, right? And the SEC said, we don't have time to do that because the SEC is in charge of overseeing all publicly traded companies and their filings and making sure things are done on time. They have to kick people off the New York Stock Exchange when they don't do what they're supposed to do. SEC has too much on their plate. So what the SEC decided to do is to give that responsibility to these other sort of private entities so that there was going to be significant focus on creating accounting rules and creating auditing standards, okay? So I want you to look in the middle for a second, because this is the one that you're already familiar with. You are already familiar with the fact that the Financial Accounting Standards Board, which we abbreviate as FASB, the FASB creates generally accepted accounting principles. So if you haven't taken intermediate already, you will be exposed to the accounting standards codification. That is FASB's rule book. So any rule that the Financial Accounting Standards Board comes up with goes into their codification. So it's all of the generally accepted accounting principles housed in one place. So if you need to figure out how to account for something, that's where you go. That's where GAAP is, okay? That is what the FASB is in charge of. Over here on your right, the Auditing Standards Board. This was a private entity that was previous to 2001, or 2002, I should say. Previous to 2002, they were the only private entity making any sort of auditing standards. And their auditing standards weren't required to be followed by anybody. They were just there as a reference. Nobody actually had to follow those standards. And then what happened in 2002, right? Sarbanes-Oxley. After all of the turmoil with Enron, the fall of Arthur Andersen, their auditors, Sarbanes-Oxley came out and said, wait a minute, right? We need to make sure that the clients, the companies, right, are implementing a system of internal control. And we also need to make sure that there is some form of oversight over who's auditing those companies. There was none previous to 2002. So in 2002, the Sarbanes-Oxley Act created the Public Company Accounting Oversight Board, PCAOB, the Public Company Accounting Oversight Board. And that board was then given the responsibility to oversee the audits of companies that have their stock publicly traded. So brand new entity established in 2002. And they were supposed to come up with rules that auditors needed to follow from scratch. And they said, well, that sounds hard, and we don't want to do that. So let's just take all of the standards that this private body has already made. Yeah, we know nobody was following them, but that's a good place to start. The Auditing Standards Board already had a series of rules that auditors should follow. They weren't required by law to follow, but here's a guideline, right? Here's some guidelines for how you should conduct your audit. The Auditing Standards Board already had that. So the PCAOB said, well, why don't we just take what they did? So the PCAOB adopted everything that was already there from the Auditing Standards Board, and then they've been building on it since then. Does that make sense? So again, in the middle is the FASB. They are making generally accepted accounting principles, right? Those are the rules that our clients have to follow when they're preparing financial statements. On either side, the governing bodies are creating auditing standards. Those are the rules that we have to follow when we are conducting our audit. Prior to 2002, there was only the Auditing Standards Board. They were making up these guidelines, but it wasn't legally required for auditors to follow them yet. Then in 2002, the PCAOB came along. They were established by the Sarbanes-Oxley Act, and they were responsible for making auditing standards. But instead of starting from scratch, they just said, we're just going to take what they did. We're just going to take what the Auditing Standards Board has already created, and we're going to build on it. Yes? Any questions about that sort of timeline and structure? This lays out, again, what each of those bodies that, again, we're going to leave FASB to the side, because the FASB is who we talk about in financial accounting, intermediate accounting, advanced accounting, because in those classes, we are focused on generally accepted accounting principles. We're going to leave FASB to the side for now. what we want to focus on, what are the auditing standards? What are the guidelines that auditors have to follow when they're conducting their audit? So just to reiterate some of what was on the previous slide, the Auditing Standards Board is overseeing the audits of non-public companies. So any company that's not publicly traded, the Auditing Standards Board has oversight over them. They issue what are known as statements on auditing standards, okay? The PCAOB, which is the one that we are going to be most concerned with, because in this class, we're focused on the audits of public companies, okay? The audits of private companies look pretty similar, but we're going to focus on the audit of a public company, Earthware. They are in charge of the PCAOB, oversees public companies. They issue auditing standards, which are abbreviated as AU, but as I mentioned, they did not start from scratch. They took everything that the Auditing Standards Board had already done, and they adopted that in 2000. Oh, what did I just do? Undo. And they adopted that in 2003. Then from there, any new auditing standards that they wanted to implement, they just built on top of what they adopted in 2003. Okay? Now, we are not going to get into the nitty-gritty rules that are included in all of these auditing standards, okay? You may remember from financial accounting, when we first introduced the accounting equation, assets equals liabilities plus equity, we begin with a discussion of foundational principles. So foundational principles that sort of serve to cement all of the individual rules that are built on top of it. Things like revenue recognition principle that says you can only record revenue when you actually provide a service or a product to a customer. Things like the matching principle. You have to record expenses in the same period that you generated revenues. Historical cost principle. Those of you who took financial accounting with me, whatever you paid for it, that's what it's worth, right? That's what I used to say. Historical cost principle. It doesn't matter what the guy before you paid for it. It doesn't matter what the guy after you paid for it or gal. It matters what you paid for it. Right? Those are foundational principles that all of the accounting rules are based on, okay? The same thing happens here with auditing standards. There are foundational principles that we keep in mind, right, as we're conducting our audit, and then the PCAOB uses those foundational principles to help make more specific rules that we have to follow, okay? The rules are listed here in the following slides, okay? So slides 24, 25, 26, and 27. I've included them there for your reference, but I am not going to go over those with you in detail. I want you to understand what these foundational principles are, okay? Because the foundational principles are what we ground all of the rules in. So if something happens within an audit and the PCAOB says, okay, we need to make up a rule for how the auditors should approach this situation, they go to these principles first and say, okay, this is our nuts and bolts. This is our foundation. So let's make a rule that stays in line with these foundational principles. So I want you to understand these foundational principles, okay? The way that you're going to understand these foundational principles is by getting into small groups. So pair up, get into a group of 3, however you want to do it, okay? And you are going to go through an exercise at the end of chapter 2. Here is our, in Moodle, chapter 2 in-class problem, okay? So you have that available. I created a PDF. And what you are going to do is read discussion case 26. It's giving you a scenario of an auditor and their client. And what you are going to do is pinpoint where has the auditor violated the principles that are shown in our lecture. Okay, so where is the auditor not abiding by the principles that they're supposed to abide by? Are you with me? And that will lead us to the discussion of the principles themselves. Okay, so the resource that you want to use when you're going through this exercise are slides 19, 20, and 21. Those outline our auditing principles. Okay? So you want to read through that scenario and you want to pick out, where does it seem like the auditors fell short? They didn't follow these standards the way that they were supposed to. Okay. What time is this class over? 11:20. Let's take, what did you say, Dylan? I don't think that's accurate. Let's take 20 minutes. So that'll give you time to get up, stretch, move around, go to the bathroom, do what you got to do, and then come back again, buddy up so that you can bounce ideas off of each other. And I want you to be able to identify where has the auditor not followed those principles. Everybody cool? Understand what we're doing? Okay, I'll give you like a 5 and 2 minute warning when we're going to come back and discuss. So go ahead, stretch, take a break if you need to, and then get started on this. You have it available for you in Moodle. Do you want me to leave this up on the thing? Yeah. Oh, you probably did too. Okay. Okay. So again, what I asked you to do is review this scenario. And now this scenario, I misspoke. It wasn't actually an auditor and their client. It was actually a consultant and their client. And what the question was asking you to do, though, was even though it might not be that typical or standard auditor-client relationship, can you pick out the things that the consulting firm, EY in this situation, was doing that would be against those principles that auditors are supposed to follow? So what did you pick out of that scenario that was sort of in violation of these standards? Faith and then Madeline. You lost your notes? Right. They use staff that didn't have the expertise or competence to perform the work. That is one of the standards that you see listed here. Auditors are responsible for having appropriate competence and capabilities to perform an audit, right? So again, and you think to yourself, well, duh, right? But sometimes we have to put rules in place for even these things that seem very obvious, okay? So that's one of the things. The staff weren't competent to perform the work. Madeline, what were you going to say? Absolutely. So the timeliness of the audit, right? So the timeliness of the work being conducted, they were in violation of that auditing principle. What else was going on that's sort of related to the point Madeline brought up? Well, not necessarily, because it doesn't speak directly to whether the individuals on the engagement had any financial interest in the client. So I don't think there's necessarily any direct violations of independence. That's at least in what's described to us in the scenario. Yeah. Okay, so again, the timeliness of the work being done, being able to give their client the appropriate information in the time period they need to base their decisions on. The one that I was, oh, please, Trent. Exactly, it violates both. So that's what I was getting at. That one thing that Madeline brought up, not only did it affect their ability to conduct their work in a reasonable time period, but this says that the work is supposed to be properly supervised. So the incompetence of the staff could have been mitigated had their supervisor been with them the whole time. You know what I'm saying? Because let's be honest, when you go out to your first audit engagement, you're not going to have a clue what you're doing, right? You're going to have the educational background to understand accounting. You're going to have the understanding of generally what the audit is supposed to entail. Hopefully you remember some of the detailed work that we do in this class, but sometimes you won't, right? But that's why you have, remember we talked about that hierarchy of the audit team. That's why the staff have a senior there. On a day-to-day basis, that senior is supposed to provide mentoring and guidance and oversight. If that person is gone, then they're also in violation of this number 5 principle here. Okay. All right, very good. So you identified again the key components of that scenario that were in violation of these principles. I want to just walk through these principles with you quickly. I mentioned to you that you're not going to have to like recite these anywhere, right? But on the exam, the first exam covers chapters 1 through 5. One of the questions is going to give you a few scenarios, and you will have to identify, is this in accordance with the auditing principles or not? And why? Why do you think so? Okay, so but it's about these 7 principles, not the rules that are at the tail end of the chapter. I've just included those in there for your reference. It's about these underlying principles. So number 1, our underlying principle is for us to understand the purpose of the audit. And I've said this to you many, many times over the last 2 weeks, right? The purpose of our audit is to form an opinion. We have no skin in the game. It impacts us absolutely in no way, shape, or form what that opinion actually ends up being. But that is our number 1 purpose, is to form an opinion on those financial statements. And that opinion, you'll see, we mentioned the idea that we're only talking about reasonable assurance that there are no material misstatements, right? We have to include those in the language that we use in our audit report. An audit is done in accordance with generally accepted auditing standards. So the second principle is just describing that, yes, we have these standards, right? And they dictate what we do, but we also want to specifically say here in letter A, what management is responsible for. Management is responsible for preparing the financial statements and implementing internal control. We, as number 1 says, we're only responsible for forming an opinion on whether they did it right or not. Management of the organization, of our client, is responsible for preparing the financial statements and setting up the system of internal control. Then number 3, responsibility. So we kind of talked about this one in the context of the question, or of the problem at the end of chapter 2. The auditors are responsible for having the appropriate competence and capability. Now, how do audit firms ensure that this is going on? You will have continuous professional education, typically done in-house within your auditing firm, right? So on a periodic basis, usually 2 times a year, we had to go for 1 or 2 weeks training. And it was 5 days a week, 8-hour days, we were in training. And a lot of times the training would ramp up as you're moving from one level to the next. So as you're moving from a staff to a senior, you have to understand. Now you see it on the job every day, right? But you have to go through the appropriate training so that you understand what are you now responsible for as you move your way up from senior, or from staff to senior, from senior to manager, from manager to senior manager. So there's constant continuous professional education in order to make sure that we are staying in compliance with this particular principle. The performance category. So number 4, we are required to express an opinion that we have obtained reasonable assurance that there are no material misstatements in the financial statements. It describes what reasonable assurance entails. So what do we need to do in order to get reasonable assurance that there are no material misstatements? We have to plan and properly supervise our work. We have to make sure that we calculate the appropriate materiality levels so that we know what is and is not important to that particular audit client. We have to identify risks within the organization's processes, and we have to obtain sufficient appropriate audit evidence as it relates to the account balances that we're auditing and their internal control systems. So performance, obtaining reasonable assurance. And then number 6, the auditor is unable to obtain absolute assurance. So again, just describing, laying out in black and white that we cannot provide absolute assurance, part of this performance set of principles. And then lastly, the 7th principle underlying our audit guidance. We have to report our findings in an official audit report, right? That audit report you were introduced to in chapter 1, you're going to see it again at the very end of the semester in chapter 18. That audit report not only tells the reader what our opinion is, but it describes that we perform our audit procedures in accordance with these principles. It describes any critical audit matters, right? So I said that that's fairly new to our audit report, where we have to describe, here are some sort of weird things that we found. It doesn't mean that they have material misstatements. It's just weird. And it was significant, so we need to bring it to the reader's attention, okay? So the reporting principle, making sure that we understand that our opinion has to be expressed in a formal way, and that opinion gets issued with the financial statements. So when you look at a set of financial statements, which you're going to have to do in, I don't think you're actually going to do that until chapter 18's homework. But when you look at a set of financial statements, you will see the income statement, statement of retained earnings, the balance sheet, the cash flows, all the footnotes, and the auditor's report. It's right in there. It's actually before the financial statements. It comes before the financial statements. Okay. So principles underlying an audit. So similar to kind of what you did in this activity, you'll be given a scenario and say, okay, is this scenario in violation of any of those underlying principles? And if so, how do you know? So sort of explain your reasoning. Make sense? Principles underlying an audit. So then the second to last slide here in chapter 2 that we're going to cover just talks about ethics. And again, this is, I don't remember if I've said this in this class or in financial, because we talk about this in the financial first chapter as well. Ethics is something that we have to keep in our mind frame as accountants in any capacity that we're operating in, but most especially in a capacity where we are providing some form of assurance to another party, right? So we are to maintain independence so that our opinion can be trusted by the stockholders, by the investors, by the lenders, by the potential customers and suppliers of our audit client, right? We have to be a trusted party. And that's where ethics comes into play, right? We have to act with this concept of conservatism, of having an ethical decision-making mind frame as we go about our audit procedures. I caution you in what I'm saying is not that we have to assume that fraud is going on every one of our audit clients, because it's not. For the most part, you are going to go on audit engagements and you are never going to find fraud, right? It's not as prevalent in the day-to-day audit engagements. We hear about it, right? You don't hear about the boring audit engagement that issued a clean opinion. You hear about the spicy one that had fraud, where someone was stealing and there was an affair going on, right? That's the stuff that makes the news. But your everyday run-of-the-mill audit, we don't go into it with the mind frame that we are assuming that fraud is occurring. But we do have to have, again, an ethical decision-making mind frame as we go about our audit procedures. And we have to have professional skepticism, which I think was brought up in the first chapter, where that's where we say, okay, we're going to give our clients the benefit of the doubt. We're going to form our relationships with them, right? We're going to conduct our audit procedures, and we're not going to go in with the assumption that they are, conducting fraud, that everything is wrong. But we do have to have a skeptical mind frame. Okay, you say that that's what it is. Why don't you show it to me? Just so I have a little backup for it, right? I have a little proof. I have that evidence. So understanding that that's the way that we go about our audit procedures. So when we talk about the audit profession, there are a set of ethical rules that we have to follow. Those ethical rules were prepared by the American Institute of CPAs. So that's not just an Ohio thing. That's an a national thing, the American Institute of Certified Public Accountants. And they have principles of professional conduct, rules of professional conduct, and interpretations of the rules. So similar to how GAAP is set up, how generally accepted auditing standards are set up, there's a set of foundational principles, then there's more specific rules, and then there's interpretations of the rules. Usually those interpretations come out of circumstances, right? This event actually happened, and we can see how the rules were interpreted and applied in that particular circumstance, okay? Again, just want you to be aware of these things. There is not going to be necessarily an exam question or a case study or anything where I'm asking you about the rules of professional conduct. but I want you to know that there are rules that CPAs are required to follow. In order to keep a CPA license, you have to have continuous professional education, right? So over a 3-year period, I have to earn 120 hours of continuous professional education. That's where I go to conferences and I do workshops. Teaching actually counts because I have to stay up with what's going on so that I can tell you guys about it. And a part of that continuous professional education is you have to have so many credit hours of ethics. So I have to go to workshops, I have to go to conferences, I have to go to different meetings that are all about professionalism, ethical decision-making, the professional code of conduct. So it's important for us to understand that, yes, there are rules that we have to follow in terms of professional ethics within the audit profession. Okay. But again, I'm not going to test you on this. It's not going to be anything specifically that you'll see on any sort of assignment. Just so you are aware, we are governed by these kinds of rules. Okay. So that's it, because then the rest of the slides just kind of go through those rules in detail, and they're just there for your reference. It's not meant to be anything that you need to be specifically sort of studying or focusing on. Does anybody have any questions about chapter 2?